Good morning, everyone, and welcome to our latest Asset Management Breakfast seminar. So thank you for taking time out of your busy schedule to be with us this morning. I'm Nargis Yunus, a partner and head of asset management at Forbes Mazars. And I'm delighted that we've chosen an interactive online session today, given Storm Chandra is doing its best to cancel half of the country. With schools shut, trains flooded, trees falling on cars, it's been quite the stress test. And the UK currently looks like it could easily host the Winter Olympics next month. Today's seminar will run along very similar lines to our in-person events, with 3 presenters and the chance to ask questions after their presentations are finished. If you would like to ask a question, there's a Q&A section where you're welcome to type a question in, and this will be then sent to the presenter to answer. Or if you're feeling brave, you are very welcome to raise a hand and ask your question directly. Please be reminded that today's seminar will be recorded and then made available to watch online. So please ensure to keep your videos off and audio muted until the end of the seminar if you wish to ask a question. Now on to today's seminars, today's sessions rather, which I trust that you will find interesting and informative. There's a lot of economic uncertainty at the moment, both at home and internationally, with many challenges facing us in the asset management sector. Our economist, James Hunter-Jones, will take you through the current outlook and what this means for us in 2026. After James, I'm delighted that Sakshi Singh, our manager in risk management, will be talking us through provision 29 of the Corporate Governance Code, which came into effect from the 1st of January, and I know has been on the minds of a lot of my clients in the last months. Finally, we have Vihan Olivier, our partner based in South Africa, who'll be talking to us about the increasing influence and interest in crypto funds and digital markets within asset management and what that could mean for us. Once the 3 sessions have been completed, I will return with closing comments and advise when the live recording will be available to rewatch for any of your colleagues who weren't available to join us today. And I'll ensure that a copy of the slide presentations are sent to you afterwards. I really hope you enjoy the seminar, and with that, I'm going to pass over to my first presenter, James Hunter-Jones, to give you an economic update. Thank you.
Thank you. Good morning, everybody. Thank you very much, Nargis. As is customary, when we do these in person or online, we'll kick off with an economic update just to set the scene and provide a bit of context to what's going on in the world and hopefully to what my other speakers will be talking about. It felt as though it would have been amiss to not talk about some of the things that are most pressing and prevalent in the news at the moment. And so I wanted to give a brief recap, I suppose, of China-US relations over the last 10 years, and then try and dovetail that into some of the things that we're seeing in terms of asset prices at the moment, some of the constraints that some of the participants are facing on a global scale, and where we might be headed from here. So with that, if we can go on to my next slide. I'd like to start off just by talking about the evolution of US policy. Now, this is all within living memory since Donald Trump first came to office in 2017. And I'm sure that many people on this call will remember that. I think that it's worth thinking, though, that the policy that we're seeing today has not always been the US policy. I think what we saw 10 years ago was different. It was erratic in its own way. I think we would say that when Donald Trump came to office, the administration was not necessarily prepared for that position. I think that it was seen as something of an outside chance that would happen. But there was certainly a sense of grievance that was brought to that negotiating table, grievance about the displacement of American workers at the hands of Chinese ascension, and since it had joined the World Trade Organization. There was also something of grievance against, or grievance towards rather, previous US administrations. And so policy there was wide tariffs announced. There was also removal or withdrawal from some of the trade partnerships and restricting access as well from some Chinese businesses to inbound US investment. So it was certainly a step change from what we'd seen previously, which had been somewhat more conciliatory under Barack Obama, but nonetheless, it set the stage. And so when Joe Biden took office afterwards, it was it was not a repeal of what we'd seen under Donald Trump, but rather it was an evolution. So we saw that the relationship was reframed as a sort of long-term competitor, a sort of managed competition, i.e., yes, the two countries were in competition, but there were rules to that competition, and as long as everybody played by them, everything would be fine. But as part of that strategic competition, there was a big emphasis on effectively domestic policy, domestic industrial policy. The CHIPS Act was momentous in terms of its scale and ambition in pulling in foreign investment into the US effectively through tax breaks and incentives. And the idea was that on a level, fair playing field, that the US could hopefully outcompete China, or at least the two would compete on that sort of level playing field, as I've said. When Donald Trump returned to office in 2025, it was something of a return to what we'd seen previously. I think it's fair to say, I don't think anyone would disagree. There's something of an erratic nature to policy making, whether domestic or international, under Donald Trump. I think that there was perhaps more organization. There was more of a that more thought had gone into that strategic rivalry, and therefore the decision was made to come in with ultimately pretty severe tariffs, ranging from roughly sort of 30 to 140%. So it was certainly it was certainly a change, but it was not, however, sort of massively different. It was not significantly different from Trump 1. I think, though, something that had certainly evolved was there was a certain amount of, frankly, disdain for some European partners within the current administration, which hadn't been as pronounced previously. Yes, previously might have been unilateral, but it wasn't as pronounced in terms of that. I suppose that sort of that disregard, we can say. And so I want to talk about the constraints. I think sometimes we think about policymakers, even and especially the US, in terms of its sort of clout that it carries on an international stage. We think of them as being somewhat unconstrained, but American policymakers are constrained, and it's worth recognizing what those constraints are. And I think we've seen them very clearly under this administration. I think the first one and the most obvious one would be the stock market and the stock market sell-off that was seen around the announcement of the Liberation Day tariff announcements that were made in Q1 of 2025. The other constraint, though, is actually the European partners. All the talk about Greenland and America throwing its weight around and effectively feeling like it has the freedom to acquire land as it sees fit. I think that it's safe to say that it is the Europeans' response to that, and it was quite a robust response. It is a constraint on the Americans, and I do think that it has led to it's led to the softening that we've seen of that stance ultimately. I'd like to talk also about China's role in this, because again, China does have a role, obviously, and although it has constraints, it is worth discussing. So I'd like to move to the next slide, please. China, I think that China's response has also evolved over time. I think with Chinese policymaking, let's say watchers do not benefit from that same degree of transparency that they have in Western media, and to some degree it has to be sort of divined from what we see. But I think that initially we saw that China was willing to ultimately also target some tariffs against the US during the first Trump administration, but also it was willing to play a game of sort of wait and see. I think that strategic competition era under Joe Biden made things more pronounced, and so there were efforts to really develop domestic industry, and I think we're seeing the fruits of that now in terms of just how dominant China is in some areas, be it solar panels or electric vehicles. So that is what, and then I suppose you could also say that the developments made in AI and DeepSeek, again, although they might not be world leading in that regard, they can still keep up at least, I think. And so again, that does embolden China's position. And I think a lot of that narrative around, oh, well, China's doing such a great job of producing these great high quality, low cost goods, um, puts it in a really good stead. But I think we should also bear in mind the constraints that China faces, which again, they're not as clear. But the Chinese economy is a constraint. I think that the issues that the housing market, an over-leveraged housing market, has faced, and the chart on this slide shows that, and excuse me, this is a fairly busy chart, but the stacked chart shows us, or the area chart shows us, the Chinese property sector as a percentage of the economy. And you can see since 2021, it's just continued to fall. The red line, however, is GDP, and GDP, except for the sharp swings that we saw during the COVID pandemic, has actually been fairly steady. And the reality is, and there's been some great research done on this, that shows that the two are not consistent. And we know, or it is widely believed, that China somewhat massages the economic data that it puts out. And actually, to say that Chinese GDP has grown at a steady, sort of 4 to 5% over the last 4 years, probably masks something murkier under the bonnet. And so, again, it's a constraint, and it's meant that China hasn't been able to bring its full force to those negotiations necessarily, but it has played its hand well, certainly in terms of its judicious use of potentially restricting access to rare earth minerals, which are crucial in the manufacture of a lot of high-tech goods. If we could go to the next slide, please. Middle powers, and here I'm really talking because most of us on the presenter side of this call are based in the UK. I'm talking about the UK. I'm talking about Europe. I think Canada has certainly come to the fore over recent days. But middle powers find themselves in a difficult position. Some analysis by the World Economic Forum released in 2025 showed that depending on the level of fragmentation, different areas of the world will suffer to different degrees, and it categorizes a certain area called neutrals. And actually, the UK, Europe would not necessarily automatically be classed as neutrals because they are quote unquote Western countries or Western regions. But under the most extreme scenario of fragmentation, neutral companies could see a significant hit to GDP, and that's shown in this chart here. I think that as the US has continued to not take into account European demands or European interests, what happens is that to some degree, Europe and the UK and other sort of middle nations, they do become marginalized, and they do actually find themselves increasingly in neutral territory. So I think we've just got to bear in mind that actually the assumption that Western nations will remain a bloc, I think, is not necessarily a given. And it has forced people's hands. And I think, as I said, Mark Carney in Canada has been the most vocal, and he has been very quick to call out a brave new world and a new paradigm and so on. And it is no coincidence that before Davos, Mark Carney was in China signing trade deals. It is no coincidence that after Davos, Keir Starmer was in China also discussing trade and relations. So ultimately, countries are not blind to this, and they are ultimately scrambling for a response in order so that they are not just left as sort of policy takers in the US China I suppose battle that is ongoing. If we can go to the next slide, please. Global trade implications are certainly there. I think these are quite well discussed because, to a degree, this is something that has been ongoing. China has sought to replace the US to some degree as a home for a lot of its exports, and some of that is simply rerouted. And I think that where you see large US imports, as the chart shows, from Mexico and particularly Vietnam, I think there's a fair argument to say that actually that is a temporary phenomenon, and it is Chinese exports going to Vietnam and then making their way to the US ultimately. But ultimately, it does it does put the world in a more fragile place, in the sense that those supply chains that were, I suppose they were very slick, certainly before COVID, and COVID certainly put pressure on them. But I think that now companies are having to build in sort of alternatives and backups, and therefore that does slow things down. It does increase costs, and so markets really ought to be pricing in the enduring geopolitical risk, which does threaten ultimately those companies and asset prices. If we can go to the next slide, please. So this is my final slide, and I always like to tie things back in these to asset prices, and I think that for all that I've talked about, and inevitably it's very hard to find a sort of bright, I suppose, a sort of positive spin, I think you would say, on everything that's taking place in terms of these sort of global trade discussions and disputes. The S&P 500, this is shown on the left in dollars, is showing very little sign of being under stress. Yes, there was volatility around the time of the Liberation Day tariffs announcement, but ultimately that seems like a fairly long time ago, even though it was only about 10 or so months ago. It feels like a fairly long time ago. US Treasury yields as well, and this is since Jan 2024. And yes, they've sort of oscillated a bit between 3.5%, 4.5%, but really they've traded in a 1% range. It does not speak of a mass migration out of US assets either. So some of I think the more alarmist narrative around US assets is probably overdone. But that said, it's not, that doesn't mean that what is happening is not manifesting somewhere. And of course, it is no secret, it is very widely talked about at the moment, that how much gold has gone up. And you can see that in Jan 24, it was around $2,000. And actually this chart, which I made only 3 days ago, is already out of date. And, we've reached $5,000 now. And so that is where this is showing up ultimately. And there is where people do not have faith in, let's say, the US economic order, they do look for assets that sit outside of it, and gold is that traditional safe haven asset, despite not having any dividend yield or earnings or any of those other things that traditionally make up a good investment, let's say. So a whistle-stop tour of everything taking place, but as I said at the start, we'd like to start these things with a bit of context. I'm now going to pass over to, actually, it's going to be a video which is given by my colleague from South Africa, Wiaan Olivier, and it's going to be about crypto in asset management. So thank you very much, and over to the video.
So just by way of introduction, my name is Dr. Wiaan Olivier. I'm a partner within Forbes Mazars Global, and also the Global Digital Asset Co-Leader. And the topic of today's conversation is in regards to the integration of blockchain-based digital assets into the asset management sector. So first, before we get into where we are today, I think it's fundamentally important that we understand as well as how we got to this point, and to cover the history of it. So Bitcoin's white paper was released back in 2008 by an individual or group of individuals that we only know as Satoshi Nakamoto. And that is where the term blockchain technology was effectively coined. So it was facilitated, or created rather, to facilitate peer-to-peer payments over the internet without the need for an intermediary. And it did this by utilizing a variety of technologies that already existed to facilitate this. So it uses public and private key cryptography that we'll chat about later, digital signatures, consensus mechanisms, and distributed ledger technology. Now, even though it was developed to facilitate these peer-to-peer payments, it has evolved into a speculative asset class because of most of the currencies have certain intrinsic values and, of course, had certain rules associated with the protocol that gave it value. Now, a lot of people would argue that blockchain-based digital assets such as Bitcoin is money. However, to meet the fundamental principles of money, it needs to be a medium of exchange, it needs to be a store of value, and it needs to be a unit of account. Now, cryptocurrencies like Bitcoin has proven themselves to be a medium of exchange because you actually can pay for goods and services using your Bitcoin. In South Africa, you can go to the largest grocery retailer and actually buy your groceries in Bitcoin. It's proven to be a store of value. So if you look at the Bitcoin price over the last couple of years, there's been an increase in the price. So it's proven to be a store of value. But unit of account is effectively where it falls short as a result of the volatility, which had been resolved with the development of stable coins as well. But for individuals to gain exposure to the asset class, that has also evolved over the last couple of years, where people initially met into coffee shops to actually trade Bitcoin and other cryptocurrencies. That evolved into cryptocurrency exchanges or hybrid custodians as we know them today, all the way to Bitcoin spot ETFs, where individuals effectively want to gain exposure to the asset class, but in a more regulated environment. And that specifically applies to institutional investors as well, as we see with asset managers and pension funds in the United States. But all of this comes down to what we know today as Web3. So just to explain Web3 as well, Web 1 was where effectively you can read information on the internet. Web 2 is where you can read and write information on the internet. And Web 3 is where you can read, write, and own information on the internet. And all of this plays into what we know today as a digital economy. This is where everything is being digitized, from data to ownership to artwork to currencies. And that is why blockchain-based digital assets is expected to play a fundamental role going forward. So on the right-hand side, I just want to illustrate this as well. A lot of people think that cryptocurrencies like Bitcoin are just some novel idea. But if you look at it from a market cap perspective, it's the eighth largest asset class on a global basis based on market cap. If you rewind a couple of months, of course, prior to this, you'll see that that it was sitting, I think, about fifth, sixth, because the asset class itself is in a bit of a slump now. But on the left-hand side, I think that's something more fundamental that I just want to illustrate to you as well. So if you are a millennial like myself, I grew up in the 90s, and we got internet on our home in the 90s. And it was utilized for limited various interaction with other individuals around the world. But fast forward to where it is today, the internet has integrated into every facet of our lives, both from a business and a personal perspective, and that we can't necessarily function without it. Now, the green graph that you'll see on the left-hand side is basically the adoption of users from 1992 all the way to 2010. And the orange graph that you'll see there is the adoption of cryptocurrency users from 2018 to date, or 2024 rather. And you can see that the users of blockchain-based digital assets and cryptocurrencies follow the exact same trajectory compared to that of the internet. And if you think how the internet is integrated into our lives, blockchain technology and cryptocurrencies is expected to do exactly the same thing. Also want to take you through this illustration on the screen as well, because this also gives you a good understanding of how we got to where we are today. So as I mentioned, Bitcoin developed in 2008, first transaction being executed in 2009. And of course, in addition to that, side chains are also being created, like the Bitcoin Lightning Network, which is actually a phenomenal development, because you can execute about 100 million transactions within 1 second at a fraction of the cost compared to traditional payment facilitators. Also, you saw the creation of private permission blockchains and the development of central bank digital currencies. And I don't want to go into that in too much detail. What I want to focus on is in the middle of the screen, the Ethereum blockchain. So the Ethereum blockchain was developed subsequent to the Bitcoin blockchain, and it had certain functionality that we refer to as smart contract technology. You were able to mint non-native tokens on the Ethereum blockchain. And that's why we saw the creation of what we refer to as ERC20 tokens, or alternative coins. So this is where you see a lot of altcoins and meme coins, all of these real digital currencies that isn't native to a blockchain and doesn't really have any intrinsic value. Hence why the handcuffs there. There's a lot of market manipulation, rug pull scams taking place by using alternative coins. So I do hope that that industry gets cleaned up a little bit. But on the left-hand side there at the bottom, you'll see NFTs as well. So you guys would have seen the news about people paying stupid money for Jack Dorsey's tweet and pictures of apes and those types of things. Unfortunately, NFTs died a slow and steady death. But effectively, that brings us to where we stand today from stable coins and real world assets. So a stable coin is effectively a ERC20 token. It's a non-native token on the Ethereum blockchain, and the business model of the larger token issuers like Circle and Tether is basically for every dollar that they receive into their bank account, they issue $1 backed stablecoin on the Ethereum blockchain. And if you look at this on a global basis in 2025, if you look at the value of transaction being executed during the 2025 calendar year, Visa plus MasterCard was $24.8 trillion US dollars. Stablecoins surpassed that to $33 trillion US dollars. So you can see it's becoming a challenger to the traditional financial world from a payments perspective as well. Fast forward to real world assets, of course. Real world assets was basically born out of non-fungible tokens because it let us understand that you can have a digital representation of a real world asset or artwork that's housed on a blockchain. Hence why you see the likes of BlackRock being the largest asset manager in the world that have tokenized one of their funds on Ethereum being a public permissionless blockchain. And we do expect the seismic shift to happen over a longer period as well. So on the screen there, talks about the Bitcoin spot ETF. So there's all the list of the Bitcoin spot ETFs, but rather the larger ones as opposed to all of them. You can see they're predominantly from the United States, of course. But on the right-hand side, you can see a couple of other countries also have launched these Bitcoin spot ETFs. But the reason for these Bitcoin spot ETFs was as a result of wanting that more regulated environment, but also for institutions to get a comfort around gaining exposure to the asset class. And it's interesting to see with these Bitcoin spot ETFs that was launched in January 2024, it took about 8 months to reach that milestone of $17 billion of inflow into the product, which is the Bitcoin spot ETFs. In contrast, gold ETFs that was introduced in 2003, it took nearly 3 years to reach that same inflow. So you can see there was a dire demand for this. In addition to that, we see this development of a strategic reserve. So listed companies around the world are actually investing in Bitcoin and other type of cryptocurrencies as a strategic reserve. And the reason why they're investing in assets like Bitcoin is because of the fact that it's fixed. There's a scarce supply. There'll only be 21 million tokens issued. It's an inflation hedge. It's predictable issuance schedule, offers protection against inflation and long-term currency dilution. It's a store of value. It's there for value preservation. But I think more fundamentally than anything, it gives the entity exposure to another type of asset class and basically diversifies their treasury portfolio as well. So from a regulatory standpoint, what did we see? So on a global basis, as we see the adoption of blockchain-based digital assets, the regulations move usually with it. Now, most jurisdictions around the world took one of three approaches. So you saw blanket bans being imposed with the likes of China. You saw regulations being issued from the get-go with the BIT license in the state of New York. And then you saw a lot of jurisdictions taking the wait-and-see approach. So they wanted to see how the asset class integrates into the traditional financial services world before they start to regulate it. So in the UK, crypto asset service providers or virtual asset service providers must currently be registered with the FCA under the money laundering regulations. And of course, this will change under the FSMA crypto asset regulation of 2025, which will bring crypto activities within the FSA perimeters and require formal FCA authorization for a variety of services. Of course, I think applications opens in September 2026, and then the regulations will kick in on October 2027. Still in the UK, we don't see any spot ETFs. There are ETNs listed in the UK, but of course, regulations need to evolve to allow this. But the UK regulator has said they want to take a cautious but evolving approach on this. So on a global basis, we see a variety of virtual asset service providers, from custodians, cryptocurrency exchanges, token issuers, payment facilitators, public and private funds. But I think fundamentally it boils down to custody. How does the fund or the virtual asset service provider go about custodying their digital assets? They can apply third-party custodians that impose a certain risk from a counterparty's perspective, and to make sure that those counterparties, of course, are SOC compliant. Otherwise, you'll see what we saw in 2022, 2023, a ripple through the market is one of these custodians or hybrid custodians crashes. A lot of virtual asset service providers and fund also opt for self-custody. That is where they take private ownership of their private key associated with the public key that controls the funds. Of course, that brings out a array of other types of risk and rewards, but you need to weigh up the two to determine which would be the best one for you going forward. Of course, the approach from an auditing standpoint is a lot more complex when self-custody is involved. Now, with digital assets being created, it was created to operate outside of the traditional financial services world. And a lot of people believe that that means outside of the existing regulations, but regulations are there for consumer protection at the end of the day. And we saw that with the like of Mirror Trading International, the largest Ponzi scheme in the world from South Africa, that was in an unregulated environment. FTX 2022 unregulated environment sent ripples throughout the industry as well. But these regulations are needed to make sure that stakeholders are protected. On a global basis, Forbes Mazars does see a lot of integration, public and private funds, strategic reserve businesses, various types of virtual asset service providers, traditional banks, asset managers that start to integrate the asset class into their daily business and also service offerings. We also see legacy businesses that actually start to own digital assets on their balance sheet to act as a hedge against the deflationary currency. But I think fundamentally, from an asset manager's perspective, what is happening is the shift is happening to a tokenization of traditional assets. And we see this in the United States, for example. The NASDAQ recently applied to the SEC to tokenize their securities on the exchange itself to bring the various advantages that the asset class effectively gives. So tokenized clearing can dramatically reduce settlement cycles, eliminating delays, lowering counterparty and collateral risk, and reducing capital requirements. And because of the tokenization of these securities, it leverages these blockchain rails rather than legacy clearing windows. So investors can theoretically access markets around the clock. A key competitive advantage over the limited trading hours of traditional US equities. But it also begs the question is, what will that effectively look like if we've got a market operating 24/7? You also see tokenization shares allowing automated actions to be embedded within the contract. So that's real-time corporate actions, automated dividend distribution, smart contract-based compliance. And it basically now allows us programmable finance that smart contracts bring to the table. So, of course, the distributed ledger also creates some efficiency, especially regarding tokenized trades and the enhancements in terms of transparency without altering that fundamental rights of investors. Of course, there are associated risks that also come with it, like market fragmentation, liquidity risk, operational infrastructure complexity, reputational risk, things like smart contracts. It has an advantage for automating various factors within the sector and within the stock exchange itself. But if a flaw would exist and that flaw would be exploited by malicious actors, it could also have a significant impact. That's why there needs to be this parallel system and thorough testing before this is rolled out in the near future. But this is, I think, in addition to stable coins, will be the talking point for 2026. That's it from my side. I do welcome any questions if you have any. So just
Thank you, Vian, for that informative session. And good morning, all. I'm Sakshi Singh, and I'm a manager in the risk consulting space. Today, I'll be speaking to you about Provision 29, staying on course for the disclosure. After a comprehensive consultation, we all know that the FRC published the revised UK Corporate Governance Code in January 2024, which introduced a new provision, Provision 29, that strengthens expectations around internal controls. As per this new Provision 29, the board should monitor the company's risk management and internal control framework and at least annually carry out a review of its effectiveness. The monitoring and review should also cover all material controls, including financial, operational, reporting, and compliance. Beyond the long-standing requirement to monitor and review the control framework, which was already there as part of the code, the companies must now explain how the board has carried out that monitoring, formally declare the effectiveness of material controls as at balance sheet date, and describe any material controls that didn't operate effectively, along with actions taken and plans to address them. Now, Nargis mentioned that this provision becomes applicable on periods beginning from 1st January 2026. Many organizations have already advanced with their work. Boards are now moving from identifying material controls to ensuring that they can demonstrate effectiveness. The focus has now moved from designing to execution. You will see on the screen a timeline journey of all companies that are trying to comply with Provision 29. It starts with the preparation stage. This preparation stage includes mapping principal risks and identifying key control areas, as well as identifying what material controls would total look like for that organization. Some organizations have also finalized these material controls in the first phase itself. This phase, ideally for a lot of our clients, has been concluded in 2025. In 2026, the focus now shifts to testing. First, through a dry run of testing and then preparing the board's declaration. It is important to note that a dry run does not really mean just testing it one time and testing it twice. It also includes the whole process of end to end coming to a declaration. Once we've done that, we come up with some sort of gaps that need to be fixed, some sort of remediations that need to be implemented. Then is a company ready for testing the full-fledged material controls and reporting and disclosing in the first annual report in 2027. With that context in mind, I'll move on to the next slide to give a brief on what we're going to be covering today and what the agenda would be. As everything that is new and significant, there are strengths, there are also challenges. And as we speak from the shift from design to execution, we can see that the boards are facing a few challenges. We'll speak about the key challenges faced by the board. The 4 challenges that I'll be covering today are: what is the rationale used to define controls as material? How do boards get assurance? What does good reporting look like? And how do we drive efficiency in compliance by leveraging existing frameworks? I shall also be briefly covering, as part of this session today, a few insights that the FRC has recently come up with as part of its annual review of corporate governance in November 2025. Moving on to the next slide, we're talking about the first challenge. The first challenge being, what is the rationale used to define material controls? Now, this is proving out to be one of the most complex aspects for organizations because it requires more than just assembling a list of controls. Boards need to be able to clearly articulate why certain controls matter most and how they link to the organization's critical risk. We've spoken enough that the FRC does not define what material is, but the FRC's guidance note does give us a starting point. Material controls, as per the FRC's guidance note, could include controls that could help us recover from the threat that the organization's business model face. Controls that help us in solvency and liquidity threats. Controls over reporting that could be price sensitive. Fraud related controls and certain IT related controls. But this list is not exhaustive. As we have gone through the preparation phase in 2025, we are seeing certain other dimensions that organizations are looking at. The two factors that organizations are now looking at is their principal risks and the risk appetite, first and foremost, because these are the most crucial areas that an organization starts the process of identifying material controls from. The second aspect is something we call critical risk areas. These areas may not appear in the principal risk register, but are essential for identifying material controls. These are areas around accounting, financial reporting, etc. Now, as we've spoken that FRC has not given a strict definition of materiality, it does recommend 4 categories of controls, like I had mentioned in my initial introduction: financial, operational, compliance, and reporting. If we add 2 more categories to these 4, and by the name of strategic as well as cyber, we get what we call a 6-pillar approach that a lot of organizations are adopting to start their work on material controls. These 6 pillars help companies ensure that they are capturing controls across the full spectrum of risks while providing a clear, consistent rationale for materiality decisions. To ensure a comprehensive and risk-aligned identification of material controls, these 6 pillars would then further be broken down into what we can call key focus areas, which would represent specific domains where risks are more likely to materialize. Closely connected to this challenge, our next slide looks at 2 essential dimensions, the questions that we keep getting asked a lot of times. What is the appropriate number of material controls, and what is the type of their nature? What we are seeing across all organizations is, sadly, there is no one size fits all answer. The number and type of material controls depends on a lot of factors. It could be factors like the characteristics of business. It could be factors like maturity of control activities, principal risks, board preference, even external reporting. Across our client bases, we have seen a consistent trend. Under the 6-pillar framework, organizations commonly identify 15 to 20 focus areas that are tied to the 6 strategic pillars, which are tied to the principal and critical risk. These 15 to 20 key focus areas then roughly come about to 50 to 60 material controls. That being said, the exact number will depend on the scale of the organization size, sector, operational complexity. When it comes about nature of material controls on the right side of the slide, we can see that they're falling into 3 layers. First and topmost, entity level oversight controls. These are the big top down governance mechanisms that are in place at an organization to look at the whole suite of controls, to look at the whole function of the organization. The second is the framework based controls, which is ICFR, cybersecurity. These are becoming increasingly important. All frameworks being there in an organization also represent a very good measure in terms of combating the principal risks that are present. And the third layer is transaction level controls, controls within processes which ensure day to day reliability. What's interesting in all of this is this trend. In this last 1 year, boards are gravitating towards stronger, more oversight controls because they're looking for standardization, they're looking for clearer accountability at the top, and effective risk management across the organization. Overall, the key point is that defining a material control is not a tick box exercise. It is a thoughtful, risk based judgment that that the boards must be able to explain and stand behind. If you can move on to the next slide, we talk about the second challenge. The second challenge being how do boards actually get assurance that their material controls are working? For many organizations, this can become complicated really quickly. Boards need clarity on the roles of internal and external assurance, the level of reliance they can place on both, and most importantly, how to avoid gaps and duplications across the assurance landscape. What we are finding effective is building a confidence map, the one that you can see on the screen. This map will give a structured view of where the assurance is coming from each category of control. As you can see on the left of the map, we have mapped the 6 pillars that I spoke of in the initial part of the presentation. And we mapped the 6 pillars to the 3 types of controls I just spoke of between the entity level controls, oversight, and other transaction controls. The right side of the map talks about the various levels of assurance, ranging from control self assessment, management monitoring, internal audit, as well as third party assurance. Depending on the mix of what the respective control in that pillar looks like, organizations are going more and more towards a balanced approach. Some controls will be okay to be tested from a self assessment perspective, while other controls are more key and require third party assurance. But the important point to note is that the boards want a balanced mix, strong oversight controls, aligned testing across 3 lines of defense, and a more coordinated approach between internal and external assurance. Ultimately, the goal isn't just more assurance, it's better, smarter assurance that gives the board real confidence in the effectiveness of its material controls. Now that we've established how organizations gain assurance over material controls, the natural next step is understanding how it gets communicated externally. On this slide, we can look at our next challenge about what good reporting actually look like. Good reporting isn't just a statement. It's a structured narrative that builds confidence. Let me start by first addressing the most common question that we ask. No, the FRC has not given us a format even now, but the FRC has given us some suggested elements of what good reporting looks like. The boxes in the green define what they have recently said are the good elements of good reporting, and you should be including that when you're looking and thinking about a declaration. Explaining how the review was performed, identifying who undertook that review, describing what information was presented to the board, referencing to different frameworks or guidelines used in the assessment, clarifying which controls were included, could be areas that any organization should look at when they come to preparing for that declaration. What we have done on the screen here is use these elements and looked at FRC's best practice insights and drafted a declaration of effectiveness as an illustrative example. We've also highlighted certain sections in the red boxes just to point out to how the various elements of this declaration on the screen tie back to the good elements of reporting in green. First and foremost, the how of the review was performed. If you focus on the bottom left big box, it talks about how the whole review was performed throughout the year by the board. It talks about including taking information from various committees, various different domains in the organizations, and testing the various controls. If I talk about who of this declaration, there are various mentions of who all were involved. There's a mention of the management taking it up. There's a mention of audit committees. There's extremely important mention on the right side top corner about an external assurance provider helping us get to the declaration and helping us get to the assessment of it. The what also is explained very clearly in this declaration in terms of self-assessments, in terms of internal audit reports. That's the information that is getting presented to the board. Referencing to frameworks, the whole declaration talks about UK CGC provision 29, compliance to that framework, also talks about third-party assurance that can help us get an independent and accountable view. Clarifying which controls were included as the fifth element. Multiple areas in this declaration talk about material controls. And finally, this declaration culminates in the board's confirmation that those controls were effective as at balance sheet date, with transparency on any exceptions and remediations. Put together, the debt text demonstrate the green principles in action: clear method, named owners, full information, anchored frameworks, and defined scope. If we can move to the final challenge that we're going to talk about. The final challenge is efficiency. How do organizations meet the requirements of Provision 29 without creating unnecessary duplication, extra cost, or yet another parallel framework? The key is to leverage what already exists. Most organizations already operate on strong frameworks, such as the ICFR, the Internal Controls over Financial Reporting, or Economic Crime and Corporate Transparency Act. Rather than building a new control universe, the most effective approach is to map Provision 29 directly to these existing structures. When we do that, several benefits emerge. We've called out a few of these benefits as part of this diagram in the boxes that you will see. First, a shared control taxonomy, which means we only define and classify controls once, removing repeated documentation styles. Second, by using a unified materiality assessment, organizations avoid multiple exercises to decide which controls really matter. We also see real efficiency through combined testing cycles, one walkthrough, one set of evidence requests, one disruption to the business. At the same time, we can leverage assurance across frameworks, using the same activities to satisfy multiple requirements without additional work. Documentation is streamlined as well with consistent standards. There is consistency in the shared governance space, integrated risk and control mapping, and common GRC tooling. By doing this efficiency mapping, we move from duplication to alignment, a single coherent approach that enhances compliance, strengthens board oversight, and delivers efficiency at scale. As we wrap up, the key message is that Provision 29 is raising the bar, but the path to success is clear. Organizations need a strong rationale for defining material controls, a structured assurance map to show where this competence is coming from, and a high quality reporting that explains the review, who performed it, what was presented, and how the frameworks are applied. My last slide talks about a few insights that the FRC gave and reiterated the message that I just mentioned above. On an annual basis, the FRC reviews a few annual reports. This review has been produced following detailed analysis of annual reports of a sample 100 randomly selected companies that follow the code. This sample includes a mixture of FTSE 100, FTSE 250, and small caps to ensure all code companies are included periodically. Briefly, if I highlight the key insights from this review, in the first box, it talks about reiterations about improving the way we monitor and review the effectiveness of the internal control framework. It talks about the fact that material control is not something that the FRC will define. It is something that the organization will own. This is not just restricted to principal risks. This can expand to the areas that I was mentioning, like critical risks to finance, reporting, compliance, etc. In the second box, the FRC talks about the current status of reporting practices under Provision 29. The FRC's findings show, unfortunately, that there is still a lot of work to do. Only 40% of the companies clearly explained what their review covered or who did it. So FRC is encouraging less vague statements, clearer, more disclosures. The top box, which is the most important box on this slide, the FRC in its recent review has highlighted good practices noted while talking about reporting and annual reports. This included strong sponsorship from CEOs and CFOs for the program, clear accountability with the ELT, comprehensive risk and control mapping, consistent GRC tooling, and partnering with external experts to benchmark best practice. Bringing all of this together, the organizations that will lead under Provision 29 are those that will build consistency, transparency, and efficiency across their control environment while telling a clear, confident story to their stakeholders. With that, I wrap up my session. Please feel free to ask any questions, and I'd like to hand it back to Nargis.
Thank you, Sakshi. That was great. So now I want to take you into our Q&A session. So if you do have any questions, can you please type them into the question box, and I will pick them up from there. But I see that we have one already, and this one is to James. So if you just bear with me, James, while I read out your question now. So for James, you've talked about currencies and flows. What's preventing Chinese assets and currency becoming the world's reserve safe haven for assets?
Thank you, and thank you to whoever posed that question. I think that's a very relevant and say a naturally emerging question from what I talked about. I think there's a number of ways to answer that, or a number of reasons that make up that answer. One is that at the moment, China itself, I believe, is not seen as enough of a reliable entity in that people are willing to conduct all of their sort of international trade transactions in Chinese currency. It just isn't. It isn't a big enough part of the global system, despite being a very large economy. I think there is another element, though, and this is really important to acknowledge. There is a certain willingness or desire to assume that position. When a country takes on the role of holding the world's reserve currency, it has to accept things that come with it, and that usually tends to be on the positive side. Yes, you have people wanting to deposit they want to store their wealth in your currency. They want to buy your government bonds as a safe haven asset. But therefore, the impact is your currency goes up, and also your borrowing costs go down. Now, the borrowing costs going down is fine. I think most countries would enjoy that. But the currency going up, if you think about China, a country that is very reliant on its exports, having a more expensive currency would make those exports less competitive. And therefore, I think the real fundamental issue is that China is not willing to allow that to happen. It is not ready for that step. Thank you again for the question.
All right, thank you, James, for that. And I have one for Sakshi as well. So Sakshi, you mentioned the approximate number of controls being around 50 to 60. Is that the trend across all industries at the moment?
That's a really good question. The trend is not consistent across all industries. Obviously, it will depend on the complexity and the nature of the business. 50 to 60 is just an average number. It could go up to 100 easily for banking industries for sure. But the trend that we are noticing, which is interesting, is like I mentioned, boards are going towards more oversight and framework controls. So the whole expectation is that these numbers are going to come down in this year as well, because the more framework controls, the more oversight controls there are, the lesser number of transactional controls are remaining. So that's why this number definitely varies across industries, but we are seeing a definite trend for it to get reduced to substantially lower number.
Okay, that's great. So with that, I think I'm going to close the session. I want to say thank you to all of our presenters and to all of you for attending. As I mentioned at the beginning, we will be sending the slides and the video recording so that you can share that with anyone on your team that wasn't able to attend today. So thank you again and have a great day. Goodbye.